Since the increased taxes on the wealthy idea went over so well in the UK, the Labour Party is trying something different right now, guys. So let's tax the regular people more too. Hi, I'm Arturo from Emifast, and we are a Dubai-based leader in global tax reduction and reincorporation strategies. And you can find out more about us at emifast.com, where we talk about things like taxes and global financial strategies, so you can make informed decisions about where your money is going. After the announcement of new taxes on non-dom income, capital gains and also inheritance wealth, many of the UK's wealthiest citizens and residents are taking off for more tax-friendly destinations like Italy, Malta, and even Dubai. And the resulting gap in tax revenue has the UK's Labour Party in some understandable states of concern. So what do? How about to cut back on bloated immigration program that has provided economic support for over 100,000 new asylum seekers, 29% of them in hotel accommodations in 2024. Or maybe they decided to reform a social security system that eats up almost a quarter of the UK's GDP, or figured out another way to cut down a debt whose interest payments account for around 8% of the UK's budget. No guys, don't be silly. Rather than look at those options that would require them to save money, the Labour Party did what they do the best. They proposed a tax increase. And only this time, the tax increase is aimed at pensioners. That's right, the Labour Party ran out of ways to tax the wealthy apparently, so now they're going after retirees and senior citizens. And I guess the reasoning is that the retirees are using the bulk of the healthcare and social services offered in the UK. It wasn't enough for them to contribute to supporting those programs while they were part of the workforce. So let's make them pay more now. And the way it will work is like this. The new state pension will raise at least £12,578 a year in 2027 before reaching £13,230 in 2029. That's not a lot of money, but it's enough to trigger an income tax threshold. And tax thresholds mean that the new state pension will breach the pension allowance, currently £12,570, at which income tax is payable. Because of this, experts say it will leave pensioners in the perverse situation where they will be handing government cash back to the taxman. Thanks for working your entire life and paying taxes, and as a reward, here's a little bit of hard pension to live on. But wait, you still owe us part of that income in the form of more taxes. Congratulations. And what a great time to be a pensioner in the UK, guys. Now, some of the Labour Party are taking steps to correct this issue, but as it stands, you're going to be taxed until you die if you're a citizen in the UK. And unlike the wealthy, who can take their income and inheritances and move to a lower tax jurisdiction, most pensioners won't have that same option. It's just one of more reasons why you don't want to be a lay player in the world of global tax and residency options. A UK resident, regardless of wealth status, who begins to explore tax jurisdiction options when he or she is still a member of the workforce will be in much better shape when they retire than someone who never considers their options and instead relies on the intelligence of the government that consistently prove why they shouldn't be relied upon. And the UK isn't alone, guys. If you live in high tax jurisdictions, you can expect to pay more and more than you should for both government services and government waste. It's not just the wealthy who need to worry here. If you agree or disagree with me, let me know down below, and always remember to like, subscribe, and forward this to a friend. See you in the next video.